Hello again. It's Mark Masterson, Managing Director and Partner at Hightower Naples, and I'm coming to you with our Q1 2025 Market and Economic Commentary. As you can see, I've titled this one TBD. You'll see why, but essentially it's because so much remains to be determined at this point as we move into the execution phase of the Trump agenda in his second term. So I'm going to cover that in detail in the following pages. Let's jump right in. As always, we start with the four horsemen of the capital markets. And in this edition, I've made two changes. Changed fundamentals to bearish, red, sentiment to bullish. And it's really simple why. The fundamentals, the picture, the backdrop is starting to weaken as we implement some of the policies. I'm going to show you that in the next few slides, but it just was too difficult to keep it neutral when the odds are rising quickly that the economy is going to slow in the next few months and quarters. The technical picture remains neutral for markets. That one was kind of tough too, because there has been some damage technically to markets, but they are oversold, so I left it neutral. Sentiment, keeping it bullish here, changing it to bullish because remember, sentiment is a contrarian indicator. So the more negative people get, at least in the shorter term, the more optimistic you tend to lean. So from a sentiment standpoint, things are getting extremely negative out there, and that tends to make you lean a little more positively. And then policy being neutral, again, a little tricky because policy is mixed right now. The fiscal spending has been at drunken sailor levels for the last few years. They're trying to dial that back via Doge. We're going to talk about that. But, the Fed has been cutting rates. They're on hold now, but now we're looking at multiple rate cuts being priced into the market. So I just left that neutral. So it's kind of a mixed bag on the four horsemen. And as we move through this further, you're going to see why. And we're going to jump right into the fundamental outlook. Now I pulled this page back in. This was from the January commentary. This is how I left it. And I called that commentary headwinds, tailwinds. And we need to update this a little bit because coming into the year, we had both headwinds and tailwinds. And most of the tailwinds were really centered around animal spirits and economic optimism, small business, and creating this self-reinforcing loop. And I will tell you that has changed quite a bit. I'm going to show you that. And the headwinds still remain, things trying to cut government spending, moving away from publicly driven fiscal policy that drives the economy to a more private sector, inflationary risks, tariff risks, all of those still remain. It's really the tailwinds that have changed. So I'll show you that. So first of all, CEO confidence. I mean, we had a nice surge and now it's really falling hard. CEO confidence has dropped to a lowest level in more than 12 years. I have to believe that has to do more with just clarity of policy and trade policy, perhaps tariffs and going forward. But CEOs, that makes them less inclined to make big decisions. Same thing on small business. Small business uncertainty has also been surging here as of late. So that's a tailwind that is now turning into a headwind. And more on small business, you've got another survey showing, desire to expand falling. And again, this is looking at their desire to continue to expand in business and make investments in small business, and they're going the wrong direction. Also, you've got this, I just put this in the roundup today, but consumers are getting more defensive. This is the expected change in financial conditions, and you can see that it has deteriorated for consumers. So what that is looking forward over the next 12 months, and they're getting less optimistic, more pessimistic, more concerned going forward. So again, that tailwind is gone, that animal spirits, and that can eventually filter into the economy. We've seen GDP expectations getting dialed back, not so much by the consensus, but this is the Atlanta Fed. They actually predict first quarter GDP will be negative now. We shall see. The consensus of 61 economists still has it slowing but positive. So to be determined, But it's an interesting fact that we're seeing with the concern there. Um, this one is interesting too because it shows consumer confidence is down and inflation expectations are up. So you have consumer confidence declining, but their inflation expectations are rising. And as I say here, that's starting to look like a recipe for stagflation where growth slows, but inflation remains stubborn. And that's a tough environment for investors and consumers. Um, I put this in the roundup today, but it's showing that the betting markets are now starting to price in a higher risk of a recession, but also with inflation staying high. So again, it's just more evidence of potential stagflationary environment, which is a tough environment. What's been interesting, however, is the actual economic data has not rolled over. The jobs data is still fine. And so there's this dynamic that's conflicting. You have consumers and sentiment and CEOs all getting more negative, but the data itself has not. And I think this may be the answer. So this is let's look at the Doge and the issues that they face. But more importantly, here's what I think is the answer behind why the data has not rolled over yet. So the fiscal year for the U.S. begins in October. In the months of October, November, December, and January, while Biden was still president, we ran a massive deficit. It was about $820 billion. So you can see that was running to be one of the largest deficits in history, is the largest deficit in history up to that 4 months. The problem is, in the month of February, we added to it. So even though Trump took over and Doge, we saw a lot of headlines about cutting, et cetera, the deficit after February was still 1.15 trillion, which is massive. So my point here is simply that this deficit has been supporting the economy. And if Doge is successful, which longer term we should all hope that they are, they're going to start cutting some of that growth, which means that the spending cuts, if they're going to happen, are still out in front of us. And here is the problem. Here's what Doge is trying to address. So this is the debt load. It's been expanding. The U.S. national debt increased 2.2 trillion in 2024, following 2.6 trillion in 23, 1.8 trillion in 2022, 1.9 trillion in 2021, and 4.5 trillion in 2022. So I think we can all agree that we can't continue at that pace. The big problem is, as you can see, debt has always kind of increased. That's not necessarily the issue. The issue is after COVID, it spiked and it never came down. So we never got back to this trend. And I think Doge, what they're trying to accomplish is just get the spending down to a level where we maybe get back to a more sustainable trend, which would be down at this level, versus get up here, reset everything up here, and then continue to run these massive deficits. It just never came down. And that's hence one of the big problems they're trying to address. Also, the government spending as a part of our economy, GDP, is at levels we haven't seen since 1945, and this was, war spending. So again, what they try to say, and what Basent has said many times, is they're trying to get government spending from 7% of the economy to like 3% of the economy. So the government's still going to support, they're still there, they're just not going to be such an overpowering force in the economy. That's what Doge is trying to accomplish. And again, about that debt expansion, you can see the time to reach U.S. debt levels has been quickening, and this is the pace we have got to slow. So the first 10 trillion in debt, it took 232 years, then 9 years to get to 20, then 4.5 to get to 30, and then from 31, 32, 33, 34, and 35 trillion, it just is mere months. So the quickening pace, and this is of course a little old, but the quickening pace is one of the challenges that they are trying to slow. And of course, as the debt load grows and interest rates remain elevated, the interest on the debt becomes a problem too. So we have to accomplish a lot by reducing spending, slowing the debt expansion, trying to keep rates under control, and so that the $1 trillion to service the debt is more than we spend for defense spending. So that's a big issue, and that's something that Doge is trying to accomplish. So it's a complicated issue on Doge. Just the success failure to me could be something like this. So if it's successful, government spending's reduced, deficits cut by $1 trillion or so. Remember, Musk started at $2 trillion. It's now 1. The economy does switch from a public to private sector growth engine. What happens? Well, the economy slows for a time. We might have a recession if that happens, and that's something that I think the administration's tried to prepare people for, is in order for this to happen, it may slow growth. Besant has said the markets might have a detox period where they come off that drug of government spending, but inflation also slows and bond yields come down. So we end up with short-term pain for longer-term gain, and perhaps 2026 really emerges as our year of full recovery. That's if Doge is successful. If it's unsuccessful, then the deficits continue to rise as they have been. The economy remains too heavily driven by public sector spending. We get some modest growth on the economy, but bond yields start to rise, and inflation has a second leg higher, and that's a problem. So, tax policy becomes an issue, and then we end up in the longer term crisis that we're still in right now, which is this knowledge that debt can't continue. So we really need to root for Doge to be successful, in my opinion. It's just a challenge to go from here to there. And I will say, coming back to the fundamentals, if Doge is going to succeed, it's all still in front of us, right? Because they really haven't done much cutting yet. But the goal, as Besant says, is to re-privatize the economy after Biden, which in this case means after the massive public sector spending. So that's Doge. That's one of the issues that I think the market and the economy are trying to adjust to, is the potential slowing there. And then the other policy initiative, which has been in the news this week, is tariffs, right? So it's funny, when I started this commentary, I originally wasn't going to talk much about tariffs. And now I have to talk a lot about tariffs because they slammed into markets on Wednesday. So here's where we are. We know that we've imposed tariffs on 50 plus countries. The actual rates on these, as you can scan, they ended up being a lot bigger than the markets anticipated, which was part of the issue of why the major market adjustment starting Wednesday. Markets were expecting 10 to 20%, and we ended up with sizable tariffs across the board. I think another issue is they aren't just reciprocal. So it's not just, hey, if you have 20%, we have 20. No, the calculation is different. It's calculated by taking the trade deficit and dividing it by the deficit by half to get to the resulting tariff. So it's not a reciprocal. So it makes it a little more challenging to determine how, in fact, another country can reduce it. Versus just, hey, if you bring yours from 10 to 5, we'll bring ours from 10 to 5. So all of that is why part of why the markets reacted the way they did. So good or bad? Well, that's to be determined, right? To be determined. Just like Doge's success is to be determined, TBD. I know Ronald Reagan, I quoted this in the roundup today, he wasn't a fan. He said high tariffs lead to retaliation by foreign countries with the triggering of fierce trade wars. The result is more and more tariffs. And we're seeing that a little bit this morning with China retaliating and other countries also retaliating. I did find an interesting article, which I added in the roundup today, by Warren Buffett in 2003, where he addressed the trade deficit, saying it's robbing our country, and proposed a solution which punishes importers. Sounded a lot like tariffs. So there are pros and cons. And here's what the critics would say of tariffs. They'd say that it's just a tax. And that is correct. It really is a tax. And the consumer and the end user ultimately pays the tax in the form of higher prices. They slow growth via less spending from the consumer and less investment from corporations, and they cut into corporate profits. So that's the critics' view of tariffs. And supporters would say, no, that's true. They are a tax, but they would make the case that it has to be done to rebalance trade that has hollowed out the U.S. middle class by destroying our manufacturing base and sending it overseas, which is true. It's hard to argue with that, as all of our companies sought cheaper labor and sent them overseas. So tariffs are the tough love that sets a solution in motion. So where are we now? Well, the retaliation did begin. As I said, China retaliated. There's a number of countries that are now thinking about retaliating. And I will say that the Trump administration is digging in its heels. So this was a quote from Besant on Wednesday. He said, "My advice to every country right now is do not retaliate. Sit back, take it in. Let's see how it goes, because if you retaliate, there will be an escalation. If you don't retaliate, this is the high water mark." Well, since then they did retaliate. Some have, and Trump this morning said, "My policies will never change." Again, there's a lot to be determined there as to the path forward, and that's what's keeping markets on edge as to the retaliation, escalation possibilities. And I would also say, lastly, on tariffs, that it's a big, big policy move. So this shows, and I've seen some different numbers here, but this shows that we went from a tariff, an average tariff rate, to up to about almost 30% from practically nothing. So we're now back at levels, tariff levels we haven't seen in over 100 years. And I will also add that the Trump administration is going to quickly pivot from the potential revenues that tariffs can generate to try to also reflect that in a tax cut. That if, in other words, if the tariffs are going to generate hypothetically 400 or 500 billion in revenue, therefore U.S. taxpayers should get a tax cut that's at least equivalent to that every year. And so that could mean that the tax cut discussion becomes more significant going forward. So bottom line, policies, fundamentals, definitely weakening. Sentiment, small business CEOs getting more concerned. Doge is just kicking in. We may get some cuts there as we need to reduce spending, which could slow the economy. And tariffs have at this point, a to be determined impact. And some of that depends on the path forward in terms of the policy. So now I'm going to move on to the capital markets. I'm going to talk a little bit about where we are, where we see things. Start with stocks, equities, where we are now, uncertainty definitely on the rise, expecting more volatility, and taking a look at what Trump inherited. Now, I know this data is a little old. This is through Q1, which is what this commentary reflects. Obviously, the last few days have changed this, but it was a tough first quarter for the index. The S&P was down 5% at that time. The NASDAQ was down 9% at that time. Russell 1000, 2000. U.S. stocks were down across the board. But what I've highlighted to clients is that under the hood, you can see that there was a lot of places to make money in the first quarter. This shows the sectors inside the S&P, and you can see a lot of positive sectors, which is why, at the end of the first quarter, our equity portfolios for our clients were positive because we have exposure to other sectors besides those that were exceedingly weak, like technology and consumer communication services, et cetera. So that's important to note that a diversification strategy can certainly help in times like this when the markets are more volatile. You can see it another way. At the end of the first quarter, the S&P was down 5%, but if you take the Magnificent 7 stocks out, which were down 15%, the rest of the stocks were flat. And of course, as I just showed you, a number of them were positive. So it just shows the skew that markets are experiencing because of the heavy concentration. And it's what I talked about in the last couple of quarters and a lot during the morning roundups is that, indexing, when you're dealing with an over concentrated market like we are now, where a handful of names are a disproportionate percentage of the index, it can be an indexer's dream or an indexer's nightmare. The last 2 years were an indexer's dream. So you had these great years for the index, but the 10 largest stocks were such a disproportionate, like you can see it here, 2022 and 2023, the 10 largest stocks were 70% of the return both times. In an up market, that's fantastic, and that's an indexer's dream. In a down market, it works against you. And so that's what we're seeing now. And that's why, being more conservative and spreading it out and diversifying and paying attention to where stocks are overvalued and where stocks are undervalued makes a lot of sense. And it's really benefiting clients this year. And I think that's going to continue, by the way. I don't think that's short term. I think that's going to end up being a longer term trend. I also want to highlight there have been a few other bright spots. For the first time in what seems like forever, the international markets were positive while the U.S. was negative. We're starting to see a little bit of a life coming in global and international stocks. This is one of the charts that I track personally. It's a chart that compares the international index to the S&P. When it's going down, U.S. stocks are outperforming international stocks. You can see that changed and it turned up. Now, it's got something to prove. You see this blue line? If it breaks out above that, that's pretty significant. It hasn't done it. It hit it and pulled back again. Okay, we got our eye on it. But if that breaks out, it may actually mean that it's finally time for international stocks to have their day. Same thing with emerging markets. So if this is going down, the emerging markets are underperforming US stocks, which has been the case for years. It just peaked out above that. And if it continues higher and starts to break out, it's going to be a significant opportunity potentially for more diversification. Same thing you can see, this is US outperformance. The purple is when the international markets are outperforming. The dark gray is US. Well, we've had this, 15-year period where US has just dominated, and we're due. We're due for a pivot there, perhaps. You can see how stretched it is, where US stocks are at 75-year highs versus the rest of the world. So again, opportunity could knock there. I just wanted to point that out. So there's been sectors that have been better. There have been positions that have been better than the broad index. You just need to maintain and understand that indexing versus managing a portfolio prudently, you can make a big difference there. I also wanted to highlight some of the things that Trump inherited, if you will, coming in. We need to understand that it has been a pretty incredible 15 years for the market, and we are due for a period, perhaps, especially in the US, where we get some underperformance. So give you an example. This is from Ray Dalio, Bridgewater. They looked at every rolling 15-year period since 1970, and wouldn't you know it, that the last 15 years was literally the best since 1970. So as I say, I wonder, can it get much better than that? My guess is probably not. As we came into the year, I highlighted this in the beginning of the year, Trump inherited an expensive stock market. I mean, from a multiple different perspectives, you can see that we're pinned to the extreme overvaluation. Now, some of this has been corrected, right? This is from the end of the year. Some of this is correcting with this market correction, which it needs to. But just understand that, it was came into the year priced for perfection, and we're not quite getting perfection. So keep that in mind too, as a much needed volatility event. Warren Buffett certainly knows that. That's why he's sitting in 30% cats, which I'll show you. But this is one of the metrics he uses. It's I think he invented it. It's according to this, it said in 2001 he developed this market cap to GDP measure. It just hit over 200%, which is extremely high, extremely high, where stocks are overvalued relative to the economy. And that's why he's been raising cash, and he's sitting in high cash values. None of this is new to you. If you follow along in the morning roundup, I've highlighted this, which is why, again, a good reason why we've been holding extra cash as well for clients for much of the same reasons. I highlighted earlier the concentration problem, where the indexer's dream, where, as long as those 10 stocks that represent 40% of the index are going up, that's fantastic. But when they turn south, like they have this year since February, it hurts the index. But it doesn't have to hurt your portfolio necessarily if you're properly diversified. So, but this is something that Trump inherited, 40% of the index in 10 stocks. And lastly, there was kind of a euphoric mindset around equities, and that makes sense when you consider that the last 15 years were the best 15 years in 50 years. But U.S., as Bank of America highlights, U.S. Households holding of equities as a percent of their financial assets is at all-time highs. And you can see a lot of times that has to adjust. It just has to adjust lower. And usually it takes either a period of frustration, obviously a downward correction, or a period of frustration for this to come down again. We saw it in the late 60s, obviously in 2000, and then there's been different pockets where it's happened. But my point is that investors are very much in love with equities, and oftentimes that calls for a period of frustration. And this just shows how, as Goldman has highlighted, retail investors have continued to just plow into the market. Now, again, this is as of the end of March. I wonder if that's still the case. Lastly, these charts are just some quick charts I'll show you that highlight patience. I've put these in the roundup, but these are the weekly charts. I do these on the weekend, and it's good to take a step back and look at the market on the weekly charts to get the daily noise out of the way. So you can see, obviously, we're moving lower. The question was, where do we end up? And you can see this 200-week moving average has been a place where the markets like to finish major pullbacks maybe we're going to reach that. We don't have to. We did break the 50-week, but it is getting oversold, so that's a good sign from the standpoint of, possibly being able to turn this around soon. But understand, and same thing here, but understand the weekly chart is suggesting that 200 may be the ultimate destination. So we may have more volatility ahead, and patience is justified. Same thing on the monthly chart. So this is the monthly chart of the S&P, really long term. You can see this blue line, this 50-month moving average, has consistently been a place where corrections end. So again, it's going to end up about the same place. We don't want to go here, right? That's a major event. You only see that. This was during the global financial crisis where we broke it here. That's very rare, but the monthly chart is also not oversold and may have some room and some volatility ahead. And the NASDAQ looks the same. Again, same thing. Same look. So patience is in order, and that's what we're advising clients as well. Looking at bonds, it's been a good year for bonds so far. Bank of America suggested that, and I tend to agree, that the COVID lows were the lows for the bond bull market. You remember when yields are falling, that's a bull market. Yields have been rising. I think they're moving lower, and if the economy slows, they'll continue to move lower. Scott Bessent has said, we want to focus on bringing that 10-year Treasury yield lower. Well, they're getting their wish. You can see the 10-year Treasury yield is breaking down. That lowers borrowing costs, brings mortgage rates down, etc. Now, the reason it's coming down is because the economy is probably slowing, so there's a double-edged sword there. But bringing rates down is a good thing because it also lowers borrowing costs for the government. So keeping an eye on bond yields. And then lastly, gold and commodities. This is where opportunity has knocked as well. You guys have seen this chart many times from me. This is a huge multi-year, 13-year base. You remember the phrase, the longer the base, the higher in space. Well, gold finally broke out, and it's been on a tear since it broke out. So, usually this kind of a run, you get a long base and you end up with a nice bull market afterwards, and it does look like we've started that. I would just highlight that we are seeing this now. Gold does need to pull back. I mean, it's stretched above its 50-day and 200-day quite a bit. So even pulling back to here would be very normal. So expect that. It's very possible, but I don't think it changes the fundamentals that it's, investors are changing their tune on gold. And again, very few invest in gold. And I think that's probably changing too, but 71% of investment advisors have less than 1% in gold. So I suspect that's going to bring some money in. Central banks have been massive buyers of gold, record central banks buying of gold, which is a good thing. And I don't think that's going to change either. So still positive there, and expect, even though a pullback is expected, I would certainly expect more upside potential. And then commodities. This has been one we talked about for a while, but this chart is one of those ratio charts. It shows when this is going down, commodities are underperforming stocks. When it's going up, commodities are outperforming stocks. Well, we've just gone through a massive window, a long time where stocks outperform commodities. And frankly, we're due for this to turn back up like it did here, where commodities outperform stocks. I think that's likely on path, because even if you look at this chart from 2011 through 2024, and you have all these different asset classes, here's the cumulative and the annualized return. The only one that was negative was commodities. So markets tend to be mean reverting. I would expect that to change in real assets. Perhaps it's an inflationary period that we enter, but real assets tend to outperform. The long-term chart for commodities looks solid to me. You have this huge bear market. COVID, they finally broke out. They've been consolidating, and now they're starting to break out again. So they may get volatile if the economy slows, but the bigger picture looks quite positive. And remember earlier in the commentary, I suggested that we're entering a period of potential stagflation. Well, guess what? The best performing asset classes in the 1970s, which is the last time we had some stagflation, gold and commodities, and then value stocks. So there's definitely opportunities. You just have to be prepared for, in my humble opinion. And gold and commodities may be those. And lastly, I'll look at the most important chart in the world, or one of them. 10-year Treasury yield is the other one, is the dollar. And the dollar's been really weak here. We felt it would break down. It definitely did break down. The tariff announcement actually broke it down even further. So, double-edged sword, a weaker currency does tend to help exports, but it also can be somewhat inflationary. So we need to keep our eye on the dollar because, the bigger picture, you can see, I think it definitely could keep moving lower towards the bottom end of this channel. And if it breaks down from there, then that's a meaningful sign that the dollar really wants to head lower, but to be determined. As so much of this, as you can tell, is to be determined. Same thing with the dollar, to be determined. The dollar moves inverse to the euro, so as the dollar's been following, the euro's been rising. They'll probably meet in the middle, and then we'll see where we go from there. And the real big picture is ultimately, where do we go with the dollar as the global reserve currencies? Because as you can see, there's never been a global reserve currency that lasted too much more than 100 years. And the USA, we started this process early in the 1900s being the world's reserve currency. You can see all these others that had the reserve currency and they lasted, 80 to 100 years. So we could be reaching a point where we may be making a change there. And I don't know necessarily what the catalyst would be or what the replacement would be, but just understand that that is a possibility to consider. So I'm going to wrap it up. Executive summary, TBD. There is a lot to be determined. Looking at fundamentals, we're just now starting to execute on the Trump agenda, whether that's the tariffs or whether that's Doge. Tariffs, the goal is to bring back manufacturing and generate revenue. The impact is TBD. Doge, the impact remains still in front of us, right? Because they need to try to cut expenses and lower borrowing, TBD. And we know that economic slowing and confidence is a tailwind that is no longer there. Capital markets, the markets are now pricing in that uncertainty. Definitely was a challenging starting point for Trump. Some of that's fixing itself. It was priced to perfection, concentrated, et cetera. But there have been opportunities under the hood and outside of the index. So that's where we're focusing for clients, as well as playing some defense, and then using other assets to add value and play defense as well, like gold and commodities, trying to position for a different environment. So with that, I'm going to say thank you for being here. We appreciate your friendship, your confidence, and your trust. You can follow along in great detail in the morning roundup every day. You can reach out to David or myself. You know our contact information. So we will be hearing from you shortly and soon, I expect, and I hope. Have a great day.